In this video, we're going to go over the math behind writing covered call options for income. So let's work on this example. Lucy buys 100 shares of company XYZ at $40. She writes a 30-day covered call, that is, she sells a call option. Now you would choose the sell to open option, not the sell to close option when you're actually doing this in real life. So she writes a 30-day covered call with a $45 strike price for $3. Calculate Lucy's ROI if, at expiration, stock XYZ closes at $40. So here's what you need to understand. If the stock reaches $45 or more at expiration, she has to give up her shares at a price of $45. But first, let's talk about what a call option is. A call option gives the owner, the person who bought it, the right, not the obligation to, but the right to buy shares at a specified price, in this case, the strike price. So whoever Lucy sold the call option to, they have the right to buy it at $45. And it only makes sense to buy it at $45 if the price of company XYZ, if the price of those shares is $45 or more. Because if the stock closes at a price below $45, the option expires worthless. So what you need to understand is this. If the stock price closes at $45 or higher, Lucy has to give up her shares, her 100 shares in company XYZ for a price of $45. If the stock price closes below $45, she does not have to give away her shares. So hopefully that made sense. So let's work on part A. Let's say that the stock closes at $40. So what happens to the call option? The call option expires worthless, which means she keeps the $3 premium that she obtained for selling the right to buy her stock at $45. So Lucy, she bought the stock at $40 times 100 shares, so she paid $4,000 for those shares, and then she sold the call option for $3. Now keep in mind, one option contract controls 100 shares. So she receives $3 times 100 shares. So she receives a premium of $300. Now her stock is still worth $4,000. The price of the stock didn't change. So if she wants to, she can sell those shares at $40 times 100 shares, which is $4,000. So the value of her stock position didn't change, but she closed out the month with a profit of $300. So that's an example of writing a cover call for income. If the price of the stock doesn't move, she can still make money. So I'm going to put plus 300 for the first scenario. Now let's look at the second scenario. That is, if the stock goes up to 43. Oh, by the way, I need to calculate her ROI. So to calculate the ROI, the return on investment, is equal to the profit divided by the cost of investment times 100%. In this example, her profit is $300 because she put in $4,000 and she got back $4,300 if she chooses to sell her shares. Her cost of investment was $4,000. And so her ROI for this month was 7.5%, which is not bad. So that's pretty good. Now let's move on to the second example. So what if the stock goes up from 40 to 43? Well, she put in 4,000 to buy the stock in the first place. Now it's worth 4,300. So if she sells her shares, or if she cash out, she's looking at a $300 gain immediately. And plus, she still sold the call option for 300 bucks. So her net profit for this month is $600. So now to calculate her ROI, that's going to be the profit, which is $600, divided by her cost of investment, which is still 4,000, and then times 100%. If you cancel the two zeros, you can take 6 and divide it by 40, which is 0.15. So times 100%, her return on investment for the second case is 15%. So let's put plus 600 as the net profit for this trade. And her ROI is 15%. Now let's move on to part C. So this time, the stock makes a significant move. It goes from 40 to $50. So because the stock at expiration closes above the strike price, Lucy has to sell her shares at the strike price at 45. She can't sell it at 50. The person who bought the call option, they're going to profit from the increase going from 45 to 50. So that gain, they keep it. The most that Lucy can gain from her shares is selling at the strike price at 45. So let's do the math. Her cost of investment is still 4,000. She gives up her shares, or she sells it at $45. So 45 times 100, that's 4,500. And no matter what happens, if the price of the stock goes up or down, because she sold the right to buy her shares, she's always going to get $300 for selling the call option. So she put in 4,000. She is getting back 4,800 from this trade. So that's a net profit of 800. So this right here is the most that she can gain from selling the call option in this particular situation. She can't make more than $800. So her ROI is going to be her profit, 800, divided by her cost of investment, 4,000, times 100%. So 8 divided by 40 is 20%. Now let's consider the last scenario. That is, if the price of the stock goes down. Let's say it drops to 35. So that's not good. So she put in $4,000. Now, she doesn't have to sell her stock at $35. If the price of the stock goes down, she can still maintain ownership of her shares. Nevertheless, she still keeps the $3 or the 300 that she obtained for selling the call option. So that 300 stays with her. And that 300 is useful because it can offset the loss that she's experiencing because the value of her shares is less. But for the sake of calculation, let's assume she sells her shares at $35. So in that case, she would have received $3,500. So she receives a net of $3,800. She put in $4,000. So she's looking at a loss of $200. So thus her ROI is going to be, put 100 instead of 200. It's going to be her profit, which is basically a loss of 200, divided by the cost of investment, 4,000, times 100%. So this is 2 over 40 times 100. And so she's looking at a loss of -5%. But that's if she sells her shares. Now remember, Lucy doesn't have to sell her shares at $35. She only needs to sell her shares if the price of the stock closes at 45 or more. That's the only time she has to part ways with her shares. So now that it's 35, she could sell it at 35 if she wants to. If she did, she's going to experience a loss of 200, but she doesn't have to. So at this point, she didn't necessarily lose money. What she lost was value. She lost value in her shares. However, if she's patient, the stock may rebound from 35 and go up to 45 or 50 later. In that case, she didn't lose any money in the trade if she waits for it to rebound. So at this point, even though the price of the stock went down, she doesn't have to sell her shares. So she lost value, not necessarily money. Nevertheless, she still received $300 for writing a call option. So in either case, if the stock goes up, she made money. If it stayed the same, she made money. If it goes down, well, she hasn't lost money yet, depending on what she does. So that's the beauty of writing covered call options for income. If the price of the stock goes up, you win. You still make money. If the price of the stock doesn't move, you still make money by the sale of the call option. And if the price of the stock goes down a little, let's say to $38, you would still make money because you received $300 even though you lost $200 in the value of the shares. And even if it were to go lower than that, let's say like 35 or 30, you haven't lost money yet. You simply lost value in your shares. Because if it goes back up, this could still be a winning trade. Now it's possible that the stock can go all the way to the ground and it may never come back again. Well, in that case, that's a loss. Some businesses, they go out of business. It happens. What can you do? But nevertheless, the sale of the call option reduces her loss. Because if she didn't write the call option, she could be at a $4,000 loss. Let's say if the company goes out of business. But now, because she sold the covered call, her maximum loss is $3,700, which means her break-even point is at $37. So now, let's draw a profit-loss diagram to illustrate the profitability of writing covered calls. So first, let's draw a vertical line and then a horizontal line. Now the first thing you want to do is you want to put the price of the stock when you wrote the covered call. So when Lucy sold the covered call, the price of the stock was $40. The second number that you want to put in is the strike price. By the way, this is an OTM covered call. It's an out of the money covered call because the strike price is greater than the price of the stock. So the strike price is 45 in this example, and the break-even point, to calculate that, that's going to be the share price minus the value of the call option. So the break-even point is $40 minus the $3 call option, so that's $37. I may have to extend this graph. It's not going to be drawn to scale, but at least you get the idea of how it works. Let's just make this 40 and this 45 and this 37. Now, on the y-axis, this represents the profit or the loss. Anywhere above the x-axis in this region, that's the profitable region. On the x-axis, that's the break-even point, And below the x-axis, that is in this region, she's dealing with a loss in value. So it's profitable above the x-axis, or it's a loss below the x-axis. So that's the y-axis. It tells you the profitability of the trade depending on where the price of the stock closes. The x-axis is the stock price at expiration. So now let's put some numbers to this graph. So the break-even point, 37, we can plot a point on the x-axis. The profitability at the break-even point is 0. Now, if the stock price, if the stock closes at $40, we saw that she will receive a profit of $300 based on the price of the call option. So we could put that number here. So when X is 40, Y is 300. Now, if the price of the stock closes at 45 at the strike price, that's where she achieves maximum profitability. And we saw that her profit is 800 at that point. So when X is 45, Y is 800. Now, if the price of the stock closes anywhere above 45, it doesn't help her any bit. She still has to sell her shares at $45. So beyond 45, we have a horizontal line. Below 45, what we can do is just draw a line to connect these points. And so that's how we can draw the profit loss diagram for selling out of the money covered calls. Now, if you want to plot the max loss, you know it's 3,700. Let's put a negative sign to that. So the formula to calculate the max profit is the strike price minus the share price plus the value of the call option, and then you would multiply it by the number of shares involved, which in this case is 100 shares. So the price of the strike price is 45, the share price is 40, and the value of the call option is 3. So 45 minus 40 is 5, plus 3, that's 8, times 100. That's how you can calculate the max profit of 800. And to calculate the maximum loss, you take the amount of money that she put in to buy the stock, which is 4,000, plus the money that she received from selling the option, which is 300. And this will give you the maximum loss. So the most that she could lose from this trade if the company goes bankrupt and her shares are worthless is 3,700. Now, for those of you who want to learn how to find stocks that are going up, I've posted a video on my Patreon page, and here is the link. It's a very brief video. It's very straight to the point, and it quickly shows you how to find stocks that are going up. So feel free to take a look at that when you get a chance, and let's get back to the video. Now let's move on to our second problem. Number 2. Jared buys 100 shares of stock ABC at $10 and holds it. The stock rallies to $50. Now Jared is thinking about selling the stock at this price, but instead he decides to write a 30-day covered call with a strike price of $55 for $7. Calculate Jared's ROI if at expiration the stock closes at the following values. So let's start with 40. So the stock was at 10, and then initially it goes up to 50. And he bought 100 shares. So he put in $1,000, and if he sells it at the top, well, 10 times 100 is 1,000, and 100 times 50 is 5,000. So if he sells it at 50, he could receive a gain of 4,000. So let's write that here as a reference value. Because what we want to do is analyze his decision to write the cover call at $50 instead of just selling the stock at 50. So if he sold the stock at 50, this would be his profit. So let's just keep that in mind. But instead of doing that, when the stock is at 50, he writes a cover call option with a strike price of $55 for $7. But in part A, the price of the stock closes at 40. So it went up to 50, but then it went down to 40. Which would have been a better decision? To sell it at 50 or to write the cover call option when it was at 50? Well, in this case, he still put in $1,000. That's his original cost of investment. And let's assume he sells the stock at 40, which is still not bad. He would receive $4,000. Now, he sold the call option for $7. So 7 times 100, that's 700. His net profit is $3,700 for this trade, which is still pretty good. So now his return on investment is going to be the profit that he receives of $3,700 divided by the cost of investment, 1,000, times 100%. So he receives, his return on investment is 370%, mostly due to the fact that the stock rallied to $50 before dropping to 40. Now, for the first part, if he were to sell it at 50, he would be enjoying a 400% return. But in either case, these two numbers are still relatively close, so it's not bad that he sold the call option. But let's consider some other scenarios. So right now, this would have been a better decision if you compare it to part A. Now, it's possible that the stock could climb higher. In part B, it closed at 54. So in this case, it wouldn't have been a good decision to sell it at 50. So let's see what his return is at this point. And let's keep this number here. So for part A, his profit is $3,700. So if it closes at 54, he puts in 1,000. He could sell his shares at $54, so he would receive $5,400, and he still receives the $700 from writing the from writing the cover call option. So he's receiving a net of $6,100 minus the 1,000, so his gain is $5,100. So his ROI is going to be 5,100 divided by 1,000 times 100%. And so he's looking at a return on investment of 510% in this example. So this is better than selling a stock at 50, because you never know if the stock is going to continue to go up or if it's going to go down. So here it went down, his return was still close to 400%. Here it went up, his return is much higher than 400%. So there's value in selling a cover call option, especially after the stock has rallied, because when a stock moves up quickly, the volatility goes up, and when volatility goes up, the value of all options, both call options and put options, go up as well. So that's a good time to sell a call option, because the prices of call options will be expensive when volatility is high. Now let's look at the third scenario. If the stock rallies to 80. In this case, it would be better for him to hold the stock and sell it at 80 rather than writing the cover call option at 55. But let's get the answer for this one. So he puts in 1,000, and because the price of the stock closes above the strike price, he can't sell it at 80. He has to sell it at 55. So he's going to receive $5,500 for their shares. And also, he still receives the $700 that he collected for writing the cover call option. So we have negative 1,000 plus 6,200. So his gain is $5,200. So here it was 5,100, but now it's 5,200. And so his return on investment is going to be 520%. So this number right here, 5,200, is his maximum profit. In the first three cases, he maintains ownership of the shares because the price of the stock didn't close above the strike price. But in this situation, he has to give up his shares. But this would be the ideal situation. Let's say if the price is initially 10, it rallies to 50. That's when he decides to write the cover call. And then let's say it drifts to 54 at expiration. So it doesn't reach the strike price at expiration. So after that day, when the call option expires worthless, he keeps the $700. But let's say after that, the stock continues to rally to 80. In this case, this will be a better option than the first scenario, because not only did the price of the stock reach the same point, but he gets to keep the premium that he collected, because at expiration, the price of the stock was 54, not 80. So if it goes up just below the strike price and the contract expires worthless, but then the stock continues to rally, that would be a very ideal scenario, because not only did he achieve the full capital gains of the increase in the price of the stock, but also he collected money for writing the cover call option. So timing is important. So where the stock price is at expiration matters a lot, and what it does after also matters as well. So that will be an ideal scenario where he can still profit from the capital gains of the stock and from the sale of the cover call option. This all depends on if the price of the stock closes just under the strike price at expiration. Now, let's finish this problem by considering the last scenario. So let's say the worst case scenario, the stock goes from 10 to 50, he sells the cover call option, and then it crashed, back to $20. So he put in $1,000. Let's say he doesn't want the price of the stock to go down any further, so he locks in his gains, he sells it at 20, which is still pretty good, and he still collects the $700 premium. So he puts in 1,000, he receives 2,700, so his net gain is 1,700. So even in this scenario, he is still winning, all because the stock initially it rallied from $10 to $50. So value investing is very profitable. Now his return on investment is going to be 170% in this example. So it's still not a bad situation. Not as profitable if it went up to 54, but he still did pretty good with this trade. So that's basically it for this video. So to review, when writing a cover call option, you're basically selling a call option. And to do that, you need to buy 100 shares of the stock first, and then you would go to your online broker, be it TD Ameritrade, Choice Trade, eOption, Fidelity, whoever it is. You would select sell to open a call option, choose a strike price, and then collect a premium for selling that call option. So that's how you can sell call options. And hopefully this video gave you a good understanding in terms of the math that goes behind calculating your profit and return on investment depending on where the price of the stock closes at expiration. Now, for those of you who want more stock related content, especially the math behind it, feel free to take a look at the description section below of this video, as I'll be posting other videos there as well. So thanks again for watching, and don't forget to subscribe to this channel if you like this video.